All right, hello everyone. Welcome to the trade findings and adjustments of November 14th, 2019. It's good to be with you again this morning. It's been a few weeks, like 3 weeks. So it's good to be back and looking at things and wanting to share some things with you. I will say it is wonderful to finally see a couple of stocks that we've been patient with, and not necessarily just this year, but throughout this year and last, and even before that. So those are the kind of things that are on my mind this morning. You obviously see Baidu up here, keeping track of it. These days are just wonderful to see. Back here on the 7th, they obviously had their earnings and did fantastic. Couldn't quite hold where it was going, but we're still in a positive spot, and I would say technically we're just coming back from overbought and just trying to, well, the market's just kind of doing what it always does and being a little bit fickle about every little headline that comes out on the China trade issues. I'm not going to say war anymore because that's just flamboyant. So that's one I think we were looking at it Wednesday, kind of thinking, well, bummer, it's coming back a bit, but with the news headlines where Trump made a comment Friday and the lack of comments on first iteration of this trade deal coming through, it just, makes sense that some of the good news that helped boost Baidu back on their earnings, in addition to their earnings, is kind of being pared back just a bit. But I'm also going to say that, you know what, Baidu hasn't been overbought here technically in at least 6 months. This is a 6-month chart, but for quite a while. So I think a couple of those things give us a little more reassurance, and certainly the fact that we have some really nice gains out of a couple of days that allow us to feel comfortable being patient. So, on that note, as Kevin and I were kind of talking, what was this? Just a couple days ago. Today's Thursday. So yesterday, this is like the most beautiful candle I've ever seen, especially on Disney. But let me walk you through kind of what Kevin and I were discussing Wednesday morning, because it was kind of started down here and headed down that first bit, and we're kind of thinking, well, geez, we had a decent earnings and it's come up a bit, but can't seem to hold 140. Emotions kind of start to get in, and you start to think, well, crap, I guess it's just, maybe it's gonna struggle to get over this, I guess, this resistance line that I'm kind of pointing out here. But as you go through and you talk through things, and I made the comment, well, we've been talking about this and talking about how, we still have the next week where the subscription numbers could come in and we could just be awesome. And it wasn't, oh yeah, yeah, we're good. Let's just be patient once again. And then to see they're pretty quick afterwards. The headlines on Disney bringing in 10 million subscribers in the first day, and seeing this just go up and hit 150 and kind of trade around there for the rest of the day was pretty cool. And it just kind of goes to show sometimes it just takes patience and time to be right, because some of you have been around listening to Kevin and I talk, especially about Disney over quite a while, and where it could get to and how well it does as a company. And sometimes stocks are stocks and they're weird and do what they do, and people think what they think, and some get a lot of ridiculous love that they don't deserve. Tesla. And some are fantastic companies that just kind of get overlooked for the dumbest of reasons. And for Disney, that was their ESPN. They had their own little subscription thing to start out for ESPN for exclusive content, and it didn't have a lot of subscribers, and it did this and that. And so one part of their business that was always overvalued as a larger part, but if you just did some due diligence, you'd see that that wasn't the case. And in the meantime, they were making billions of dollars on movies every year, and parks doing fantastic. And as I'm rambling here, let's go back 3 years and just kind of see. This is kind of what we dealt with, all the way down to 94, 95, couldn't stay over. And if we went back another year, I'd have topped out at like 120 and came down. 2017, 2018. And then this year, stuff finally coming through. And they've always done a great job making money, but taking some market share away from Netflix possibly, and utilizing the amazing content they already had was kind of enough to get the market's attention and get people to realize this is a fantastic opportunity. And managing their situation with ESPN that hadn't gone quite as well. And that's why you invest in good companies, not because they always have internal investments that always do well, but how well they manage those when they don't. And in my eyes, Disney has done a fantastic job managing those investments. And we've gotten quite a bit of flack from some folks on, why are we in Disney? This is silly. Why can't we sell Disney and buy more Apple? And I don't know. I guess I'm just trying to say you deal with some of these things as an advisor looking through uh, the stocks you choose and the companies, more importantly, that you believe in, you certainly can go and index the market and do that sort of thing. And you could, well, let me say this. So sometimes the flack I get with discussions with people, either some clients or just some people that I talk to, it's the conversation kind of goes like this, and it's, well, you can't outguess the stock market, and so why bother? Why not just index and do that sort of thing? And my response is, well, I'm not trying to outguess the stock market. I'm investing in companies. I'm not looking at stocks as stocks. I'm looking at companies as companies, and trying to ignore some of the noise that the stock market brings. And there's advantages to that, and there's disadvantages to that, and there's advantages to having so much liquidity, ease of liquidity in stocks, and there's disadvantages to that. Um, Again, it gets kind of fickle, uh, swings in the market and things selling off for really silly reasons, and things taking off for silly reasons too. But if anything, Warren Buffett has taught the world is that you look at these things as companies, look at stocks as companies, and you do your due diligence and you stick with them. And the way we manage it in the meantime is protecting for the risks. And yeah, through some of this period, especially closer to here where it kind of goes pretty much directly sideways, it costs money to be protecting, and that can look like, a bad thing that we're spending money on protection. And the problem is, then we have stuff like this happen, and stuff like this happen, and all of that time spending money through flat periods and also through periods that fall over here. I'm sorry if this is kind of little, but maybe I can zoom in here. Periods through here where we've built up shares with protection and built up shares with protection, and falls like this. This was more of the end of the year, last year, where everything kind of dipped and came back. But I guess my point is, yeah, there's a couple of ways that you can invest in the stock market. One is just by indexing and knowing that because you can't outguess the stock market, just don't try and go index. Go buy a SPY or a QQQ and a few ETFs there that allow you to do that, and sit through it and go for it. But I'll make the point that if you're paying an advisor to do that, that maybe you're wasting your money. Because an advisor indexing for you is going to put you into their special mutual funds that attempt to do the same thing as the cheaper ETFs, and they'll probably get sales commissions and kickbacks for it. I could do the same thing. I could do the same thing for you as an advisor. I could go and say, obviously you can't outguess the stock market, so we're just going to put you into these things and be passive. But I don't believe in that. I don't believe that that's value. that anybody's adding to your retirement or investment account or what have you. I think it's a waste of money. And it's easy enough for anyone to go out there and do themselves. So that's why I choose to do value investing and color trading, and having the opportunity for days like this when we've suffered through periods of the summer going up and down and just kind of sideways, where we've spent a little money to protect and it still went maybe sideways, or we made up a little bit but not enough to buy more shares of stock. And then that's kind of how it goes sometimes. That's kind of how Disney has gone. But if you have those couple of times a year where you can lower your cost basis on times where you've had to just spend money on protection, it comes back to help you. And you get a couple of those times to build shares, and finally we see some wonderful things happen. And I feel like that adds value in people's investments accounts. I feel like watching over this stuff and having and building the experience through different market situations and economic situations that we can advise people and make the best decisions that we can possible, that adds value again. And some of you are pretty regular with being on some of these videos, these webinars, and I hope that you see the value in going over these things, being informed on the market. I would say that those of you who regularly follow with us, especially the Monday night market commentary, are vastly more informed and knowledgeable than most people that just watch the news or just just read the headlines. We dissect it, we go through it, we say, this is just a headline, there's really nothing to do. This is just Trump talking big and Trump doing that, and this is just that, and this is actually more of a concern than the market's giving it, and so on and so forth, where we can kind of give you some thoughts, help you sort through some of this ridiculous stuff that we have to deal with the China trade war and so on and so forth, where I hope that you're seeing that we deal with things and we deal with the emotions of trading and the emotions of wanting and wishing some of these stocks to go up sooner than later, and some of them to, show us that we're right sooner than later. But that's just how it goes. And I would rather beat the market in the long term by value investing and building shares, because timing is virtually impossible over a long period of time. Over short periods of time, which is why you give yourself time to be right. and it pays dividends, and most of the time that's literal. So I've kind of been rambling on, hopefully made some points that make sense to you. Before I go into some possible ideas, are there any questions or thoughts from you guys so far? Apparently I got logged out here. And I'm going to pause my screen share. Hopefully you guys can still hear me. Just want to keep accounts private that I can. All right, bear with me. I'm trying to log back in here to my account. Not seeing any questions so far. Huh. All right, so here's what I'm getting. Error loading application. It's not letting me in at the moment. Trying again. Okay, I think this might work. There we go. All right. Back to our chart here. So what am I looking at today? So I hope that some of the things that Kevin showed Tuesday, I think was a Disney bull call, if I remember right, that you could have taken fantastic profits on. If you haven't already, go for it. For the most part, what we have already is looking pretty good. I was thinking along the lines of looking back at Target again. So, well, let's look at a decent chart here. So if you remember, we've done a couple Target covered calls that have done really well and expired for calls expiring for full profit, which is cool. The reason I'm kind of looking at this as opposed to some other options today is because Walmart just knocked it out of the park with their earnings and their guidance, which said that they're basically going to make ridiculous amounts of money over the holiday this year. And that is getting a boost also to Target. So on one hand, I'm kind of thinking, well, a covered call at this point, when we have earnings on the 20th next week, I believe that's, what is that, Wednesday? Double check. Wednesday next week. Dividend next date on Tuesday. So I'm actually going to be thinking more towards a protective put, shares and put protection to go through earnings as opposed to a covered call. Mainly because if we've already done some of the covered calls, you should have some decent profit there. We're looking at a dividend and possibly some pretty awesome earnings if Walmart is any indication of how that might go. And let's just check real quick what Walmart looks like. Well, not necessarily holding some gains that they opened up at, but they did have some fantastic guidance. So real quick, just looking at some of these headlines, Walmart earnings top, e-commerce sales surge. I'm not necessarily seeing anything why it would be down. So I'm going to chalk that up as hitting a resistance level at 125. But let me just look. Yeah. That kind of has every headline imaginable. Let me just do a quick search here on my, well, it's going to go on my phone. Let's check out CNBC just real quick. So a new 52-week high, obviously this morning. So Walmart is growing market share. Cisco CEO, big companies concerned about macro. Yeah, that's just other news. I would say they're just coming off of a new 52-week high, and I would expect it to continue to go up and have a base of around 120 as a support level. So back to Target. December, 36 days. Let's see. Look at an odd week as well. Those are rather expensive, it would seem. December. So for 110s in December 27th, there are about 490. So for a few more cents, 30 more cents probably, you go out to December 27th, then going to 110 on December month expiration. And you get the option of going to 111. Let's see what the 13th has for 111, which is a little bit in the money. So it would be pretty cheap compared. So I'm just looking at some of these odd weeks where you could go 111 or even higher for put protection. Knowing that Target may have a pre-earnings run kind of like this into their earnings next week on Wednesday, where maybe Friday, Monday, they could get up to closer to 115 Monday, Tuesday, and you'd be wanting to protect at that price rather than putting things on right now and protecting. So maybe one thought is a protective put down at 110 if you were to buy it now. And another thought is to hold on to some stock or look at it maybe tomorrow and see whether it goes up or down. But just as we're looking right now, if you were to buy a 110, buy stock at 110, and protect it at 110. So the 13th gives you just under 30 days. It's going to be a little more rough on that one if it goes up because it's a little more near term. Whereas if we go out to the 27th or the monthly for 70-ish for 110 for it may save you some of that. Let's see, going back to the 27th. Yeah, again, a couple more dimes to go out a little further to protect. So here's a couple options for you. I would be looking at a protective put stock and put through earnings next week, but you have the option to wait on the put portion, maybe through see what happens Friday, see what happens the beginning Monday, Tuesday, and possibly adding protection if it gets up closer to 115 like it did back mid-October, because we're still getting quite a bounce a good $2 bounce today on positive expectation on Christmas earnings sales. So if you're looking at doing right now, today, I would go out to the 27th. Specifically because we get a little more time with less influence on volatility, as well as being in the month of expiration on those December 13, being a month away, under a month away, you'll get some theta decay, or to not be so technical, it just, you get price decay when you get closer to the expiration. So that's what I would be looking at, 110 out to the 27th. If you have 100 shares, you buy one put, and you can even, at that point, after earnings, if it has a good earnings and heads up, you'll be wanting to look at guidance, because that is what is really going to make it move. Guidance being their projected earnings and sales in the near future. And at that point, you could take puts off. If it gets up to closer to 120, you could add short calls and start the whole thing over with a covered call position and do that whole thing again. So while I'm kind of putting this stuff in, is there any questions, guys, or thoughts, concerns you have? You certainly could make the case that you could pay less for protection on 110s if it goes up a bit. So again, one option is just to buy stock, see how the next couple market days go. To see if we don't get a little bit of a run up. To protect it either at a higher price if it gets up to one, I mean, anywhere it gets to, I would think the near term resistance level before earnings is going to be 115. But wherever it gets to, you could protect at the money. I'll highlight that. Or just down at 110 to save some money, because 110s will be cheaper at that point, probably closer to $3. And play it that way. So those are some options. Those are some things to think about. Any thoughts or ideas or other questions? I struggle with the formatting on this. You get the idea though. Not seeing any. Oh, we do have a question. Question from Ida. Is there thought on synthetic stock ideas? I assume you're talking about long calls. Let me see. For a bull call type thing, I would probably go out to at least January, do something like a 115, 120. You even go try something like that, more close into the money. Lowers your break even down to 112. Spend 222. Yeah, so that's an idea if you're looking at more of a profiting from the run up. I would suggest that doing a stock and protective put would be a little bit smarter and a little more conservative. But this is an idea. Again, I would suggest a protective position. Guys, are there any other thoughts or questions? Or I guess I shouldn't say protective position, but a more conservative stock ownership and protecting stock position. Does that help, Ida? Okay, perfect. All right, guys. Well, I think that's it for me. Is there any thoughts or concerns or ideas? I will give you a quick update. Activision. I had put this one on a couple weeks ago, and dang it if the stupid thing just fell. And I had a bowl. I'll show you what I had. I had this, which was a bull call 55 to 59 short that I rolled down to a bear call to make up some of the downward movement. This is my little slush fund account, by the way. I haven't shown this before, but I did want to show you a frustrating one that I am having to adjust and be thankful that I have some other really awesome winners to offset it. So 56.50 calls against 59 shorts that I booked for a profit, rolled down to 55 bear call, where we are at down 400 to try and make back another 48 cents. I believe that lowers my cost basis. Booked $1.50, I think. So I am going to be out about 50 cents, assuming this short closes for a full profit. And just trying to lose as little as possible. That one, the game, usually those good numbers coming out on the games just helps things a lot, but I think we kind of missed the run up from where it was down here when I had gotten in closer to around here. So chalk that up as a loser and make fun of me as you will. But you know, you take what you can get and you adjust the ones you can. And if this one reverses on me, I'm just going to have to be pulling off these shorts and seeing what the longs can make back for me and go from there. But any other thoughts, guys? This is it for me. Thank you for joining me, and give this one a look. Hope you guys have a wonderful day and a wonderful Friday. We'll talk to you again soon. Goodbye.